Hi, I'm Max Keiser. This is the Keiser Report. You know, we're going to count down the next few shows toward an historic day in monetary history. That would be August 15th, 1971, the day that then President Richard Nixon closed the gold window, basically defaulting on America's obligations to Great Britain at the time. And since then, we've had pure monetary chaos. Stacey.
Yes, that was known as the Nixon shock, and that's where you can find it under Wikipedia to research that. Over the next 2 weeks, we're going to be looking at that, building up to this 50-year anniversary of a great monetary experiment. This is a monetary experiment, right? Because this is the first time we've had a global all-fiat world based on basically nothing but paper, backed by, as Paul Krugman at the New York Times, a Nobel economist says, backed by men with guns. That's a first. We've always had hard money or hard wealth creation, real wealth creation. So this is the first time we've been beyond that sort of system. So it's an experiment. We're 50 years into it, and results and the consequences of this. We're researching the experiment.
Right, so there's two parts to it. There's a monetary relativism, which is that fiat money in one country was valuable relative to the fiat money in other countries.
Yeah.
And so that entered into an era where value, a standard of value, became almost impossible to acknowledge or maintain. The other thing it led to was that previous to this, central banks were somewhat autonomous and obliged to perform in the interests of the countries that they were in. You know, the Bank of Japan, Bank of England, Federal Reserve Bank, European Central Bank, are the precursors to the European Central Bank, and all the various European countries would be involved in policies that were seen as beneficial to those countries. After the Nixon shock, and for the past 40, 50 years of deregulation, we've seen collusion, as Nomi Prinz writes in her book called Collusion. And this is about how central banks now work in concert with the same expansionist policies. And so the same problems are now being experienced in all countries.
Here's the headline, 2 words: no resistance. And this is the headline from wolfstreet.com, no resistance to price increases. Reports are coming from all directions, from small mom and pop operations to large corporations. Input costs are surging. Wages that companies have to pay to attract workers are rising. Transportation costs are surging amid driver shortages. Supply chains are tangled up, and there are delays and bottlenecks, and suppliers suddenly can't deliver because they've run out of something. And companies are furiously juggling these issues, and they're raising their prices to make up for those higher costs. And there is no resistance to these higher prices. Consumers are willing to pay whatever. Usually there's resistance over the past few decades, and companies have to do whatever it takes to try to figure a way out to reduce their own costs in order to keep the same price for their customers.
Right. The last time we had resistance was back in the late 70s, early 80s with Paul Volcker, who was running the Federal Reserve at that time. And after Nixon let the genie out of the bottle, Paul Volcker had to raise rates to very high mid-teens to form some resistance or to create some scarcity. We have had, since Paul Volcker in the age of Margaret Thatcher and Ronald Reagan in the era of deregulation, this runaway derivative growth that has created what's called the shadow banking system that's not accountable to anybody. And periodically you'll have crashes, and that's where the resistance comes in, whether it's the crash of 87, the bond crash of 93, the subprime crisis of 2008, et cetera. That's where the resistance is. And even Alan Greenspan said that Fed policy is no longer to try to manage the economy, it's merely there to clean up the mess after the crashes, which is what he said. But this idea of creating artificial shortages or artificial scarcity, and you could encapsulate that in the work of Milton Friedman in the monetarist school out of the Chicago School of Economics. We now have runaway inflation from decades of money printing, and the bodies are now surfacing. They can't bury the bodies. They can't hide it anymore. There's no more hedonic adjustments. And people are starting to realize it, and it's happening on a global basis, which leads to the famous phrase uttered here on this show by Max and Stacey, global insurrection against banker occupation. It's now global. It's now here.
The other thing I want to consider, Max, is when we've talked about this, that the stagflation, the inflation happening right now is similar to the 1970s. But the thing that's different is, of course, the new generation. The boomers were the young generation, the equivalent of Generation Z back then in 1971. Now we have Generation Z and the younger millennials at the same age. So back in the 70s, of course, you were coming off the hippie movement, the resistance movement. Everybody was resisting the draft, and it was all about free love and stuff like that. Now we have no resistance. So where are we from that point of view? Because back then, the boomers were born and raised in a time of wealth creation, rising wages, rising real wealth, a manufacturing powerhouse. And now we have a generation that was not raised on that sort of economic model, was not raised on a gold standard. They were raised on more of, a Zynga sort of gaming, like virtual reality platform and economic system. So whereby like these Biden bucks, before that was the Trump dollars, the stimulus checks, the stimmies, like the no resistance to price increases makes sense in a way. They don't have that same understanding of the economy and monetary policy. They feel like, on their games that they play all day, it's easy to just credit your account with more new Linden dollars or whatever it is,
Right, you mentioned Zynga there. They were the company behind Farmville. Farmville was one of the early applications or games available on Facebook, and it really made Facebook, get that first 100 million users or so. And absolutely right. So virtual reality, virtual economics, virtual currencies is where this generation is most familiar, and that's their understanding of economics. And people often say that life is all about powering up. And like in a game, a world of witchcraft where you get an extra sword, you get an extra weapon, and that's what people understand to be the economics. What we're seeing now is the difference between inflation and hyperinflation. So inflation is a monetary event, hyperinflation is a political event. And when people lose confidence in the funny money, the game currency, the US dollar in this instance, then you get hyperinflation, which is absence of confidence in the dollar, and we see that in other currencies. Because the dollar is world reserve currency, it has other complications involved. But at this rate, I think on the 50th anniversary of the US dollar in its pure fiat form, going back to 1971, August 15th, what we're going to see is a collapse.
So there's no resistance to the price increases, certainly not from this new generation, the Z millennial. They're out there and happy to pay these price increases. All value is subjective. If they feel like these virtual currencies are good enough for them, that's one thing. But the problem is when you do actually need real supplies, like you do need food, you do need somebody to actually go out there into the field, plant the seeds, hedge their risk, reap the harvest, do all that stuff and deliver it to you. So in the 70s, and we're comparing these two generations because in the 70s is when the Nixon shock happened, 1971. 50 years later, today, we're having another supply shock. The supply shock back in the 70s was the oil embargo that first started. We had one in the early 70s, and then we had the Iranian Revolution in the late 70s. So we had these all these supply shocks, or the second one was a fear of a supply shock that didn't actually materialize. But now we have a supply shock similar in the U.S. with various goods, including agricultural goods. So you're seeing all the restaurants, the fast food chains even having to pass on huge costs to their consumers. There was a recent call with Chipotle, and they were mentioning that they raised their prices by 3.5% to 4%. Classic sort of fast food chain that is beloved by millennials and Generation Z, and they raised their prices by 3.5% to 4%, as the earnings call just last week said. And they were surprised, no resistance at all. The consumer is willing to pay, and they were kind of suggesting there might be some more increases coming very soon. The meat prices is the other thing, and this is where you're seeing a shortage in supply. There is plenty of meat itself, but meat packers are having one heck of a time hiring staff and filling orders amid red hot demand, particularly from the restaurant industry, and suddenly meat prices are jumping. Even the Bureau of Labor Statistics picked up on it with its CPI report for June. The price of uncooked ground beef, for example, jumped by 3.4% in June from May. Uncooked roast jumped by 5% and steak by 6%. Pork chops, roast, and ribs jumped by 5%. So, of course, they lose control of their hedonic adjustments, right? Because ground beef, of course, is always the classic hedonic adjustment for steak. Steak prices are up 6%, so people are just going to replace it with ground beef. Instead, ground beef is also up 3.4%.
Right, and they're trying to replace ground beef with bugs, right? Let them eat bugs.
Yes, yes.
Right, well, now this is a definition of a classic Ponzi scheme. And we have what are called the good Ponzi schemes. People would describe America's Social Security system as a good Ponzi scheme, right? The young people paying into it today are the ones who finance the retirements of the people retiring today. And that's essentially a Ponzi scheme, right? You're living off the new money coming in. But it's called a good Ponzi scheme because there's nobody losing until the pot of money in Social Security would run out. Then the whole thing would collapse. Well, because we've got a situation now where the money in the Social Security scheme is running out and it is about to collapse, you're going to have a catastrophic event happening in America's safety net, as we see in Social Security. But as you're describing it in the supply chains and the basic underlying cause of inflation, it's a similar Ponzi scheme. And people who are getting the stimulus checks are participating in a Ponzi scheme. They're getting free money from the government to buy overpriced meat. As long as that free money keeps coming in on the Ponzi scheme, then this Ponzi scheme is a good Ponzi scheme. This is, of course, contingent on one major factor in the global geopolitical arena, and that is that China continues to finance America's economy. As long as they continue to do that, all is great. But last I checked, there seems to be some acrimony between these two superpowers. Maybe China won't be financing America's economy much longer.
Nixon shock started in 1971. We're going to be covering that for the next 2 weeks. Here, we have a situation whereby as these prices increase, I think the money printing will have to increase, the stimulus checks will have to increase. So we'll see how that goes, whether we're going to get more and more high inflation, super high inflation, like double-digit monthly inflation like we had back in the 70s.